And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Thursday, second best day of the week as we get ready to wrap up this week. Now, of course, so a couple things coming up. Tomorrow is the employment report. So this will be the employment report for the month of September coming out tomorrow. Expectations right now are for 150,000 jobs, which is weaker than the historical trend that we saw in 2023. Back in 2023, we were doing about 220,000 kind of on average, give or take. So 150,000 jobs is certainly slower than what we saw back then. But also, those are the revised numbers, by the way, so that includes that 800,000 revision that we saw just recently. So, but while 150,000 jobs is weaker trend, certainly showing some signs of slowing economic activity, right? And this is one of the interesting things that's going on in the employment kind of force right now is that we are in the midst of what is known as labor hoarding. Labor hoarding is where companies don't want to fire employees, but they also don't want to hire anybody. So they're just hoarding the labor they have. And that's because there's just enough demand right now to support the current labor force. But I don't want to fire those guys because if the economy does do okay and we kind of don't have a recession and things start to accelerate at some point, if I fire a good employee, they're really, really hard to get back, or I can't get them back at all because they get a job somewhere else. So labor hoarding is kind of what's going on right now. We see, very low terminations in terms of discharges and layoffs. Now remember, the reason that that's important is that the only way you can file a jobless claim, right, is to be fired or terminated or discharged for some reason. Then you go file a jobless claim. If you quit, you can't file a jobless claim. So this is why jobless claims still remain very, very low. At the same time, those terminations are continuing to drop pretty sharply. So we're just seeing this really interesting environment where we're hiring just enough people to kind of support slowing demand. And so that's why tomorrow you'll see this kind of 150,000-ish job report, so to speak. That's the estimate. Could come in weaker or stronger, depending on seasonality. Also remember that September is back to school. We just got everybody back in school, so everybody's kind of getting hired for those supports. So August, September, you kind of see a little seasonal adjustment for that. But one thing to note is that 150,000 jobs, while weaker than the previous trend, is not recessionary. So again, this is some more of that evidence right now, is that the economy is indeed slowing down, but we're not in a recession yet. Now, that doesn't mean that we won't come back and revise these numbers and find out that we're in a recession, starting now. But there's enough evidence right now that the economy is doing okay. It's not doing fantastic, it's doing okay. It's also not recessionary at the moment. So again, take a look at services, in particular, recent service report, those are still expansionary. Manufacturing continues to remain in recession. But we've seen that before. Back in 2015, 2016, we had a period of time where manufacturing was weak, but services were strong. We didn't have a recession. 2012, we had a manufacturing recession. That was when Japan got hit by the tsunami, earthquake, nuclear reactor disaster all at the same time. Shut down shut down Japan as an exporter. We had a manufacturing recession, but services were never in recession. And so we never got into a recession here in the US. So it's not unusual to see manufacturing in contraction territory, but services support the overall economy because, again, our economy today, now, had that been back in the 70s, that wouldn't be the case, right? Because manufacturing is 80% of the economy. Today, it's inverted, right? So 80% of the economy is services, 20% is manufacturing. So manufacturing can be in contraction, but us not be in a recession. I know that's kind of hard to kind of grapple sometimes, and you get a lot of headlines, from ISM manufacturing reports, et cetera. The Fed, the Fed regional indexes, like they're in contractions, like, oh my gosh, those are clear recessionary signs. Yes, but you have to remember services make up a very big chunk of the economy today, and that activity is keeping the economy afloat for now. Again, that doesn't mean that eventually this won't change. But keep a watch on this employment report tomorrow. It'll be important. It will move markets. It is going to be the focus for what the Fed does next. A really strong employment report will likely bring down expectation for Fed rate cuts to just 25 basis points at the next meeting, kind of remove some of those expectations of 50. But we'll certainly get into that. All right, here's what you need to know before the bell this morning. So markets did sell off a little bit yesterday. We were down over 1% yesterday, but then kind of rallied back towards the end of the day. And that's been the nature of this market as of late. We're kind of down early in the day. Institutions come in the afternoon, kind of buy the market back up. So there's still good buying demand in the overall markets right now. But from kind of just a position or a technical analysis of the overall market, we're currently in that kind of good position at the moment. If we go back and look at these previous highs, going back into July, we just came down yesterday, retested those highs, bounced off of that retest of those highs. So again, from a technical perspective, this is kind of just a good classic retest of a breakout. Now, it's going to be important to see if the markets can hold that. Now, futures right now are pointing lower, so we're going to try to come down and flirt with this 20-day moving average again, which also kind of coincides with this breakout to recent highs. The market needs to hold here. If not, we're going to get a little bit deeper correction here, potentially come back and test either the 50 or the 100-day moving average, certainly well within the context of kind of moving into this pre-election environment. But we've also got to deal with this uptrend of the markets that we've got also, which is going to coincide right around the 50-day moving average. So we have this rising uptrend. The market comes down, test that kind of rising trend line, should hold support there in theory. Again, a breakdown below that, you're going to break down out of this ascending wedge pattern, and that's going to suggest that we have a lower potential move in the markets coming if we do break below that. But right now, market should stay somewhere within the context of these support lines for a bit of a pullback here. And again, we kind of needed that. Markets were overbought. As we noted previously, we are working off some of that overbought condition already. Now, here's the one thing to be watching, though. if the markets do close lower today, we're going to trigger a MACD sell signal. And again, these aren't the end of the world when you get these sell signals, but it does suggest typically some type of corrective action in the markets that occurs when you get these type of signals. And again, we're going to get a sell signal today from a fairly high level that would suggest a bit more of a corrective move in the markets. Again, a retest of that 50-day moving average, challenging this uptrend, certainly would not be surprising going into the election over the next month. So again, this is kind of something we're going to be working on today. After the show, we'll be taking profits in some of our utility stocks as an example. They're very, very overbought right now. That we bought utility stocks earlier this year on this whole idea of energy demand by AI. That got picked up by the whole market. So a big chase in utility stocks. So we're going to take some profits there, just rebalance those positions back to target, raise a little bit of cash. But again, just try to take those actions. You know, if you've got positions in your portfolio that just simply aren't working, maybe time to let those go. If they're not working in this market, you've got some of the strongest breadth in the markets that we've had since 1999. So if you've got a position that's not working in this market, you should probably let it go, because there's something fundamentally wrong with it and why it's not working. But we're going to talk some more about that with Michael Lebowitz this morning as well. But again, just keep a watch on kind of the overall market itself. Again, there's no big risk to the markets, nothing to be overly concerned about, but a bit of risk management here would certainly be warranted, particularly if we do start to trigger a short-term sell signal. That's what you need to know before the bell this morning. When we come back, we'll pick up with Michael Lebowitz, so don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Medicare open enrollment starts October 15th. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the Insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So I have a small complaint this morning. I'm watching headlines on our news monitors in our studio right now, and Markest is saying right now that we don't have enough money for hurricane relief following Hurricane Helene, which has caused a massive amount of damage. FEMA does not have enough money to help our citizens in need, but FEMA spent millions of dollars supporting illegal immigration over the last couple of years, and we're sending billions of dollars over to Ukraine, but we don't have enough money to help U.S. citizens in a time of need during Hurricane Helene. This is the problem with government spending. And we talk about this a lot on the show about the waste of money, the things that we do, and then how we allocate funds, et cetera. But, this is where I have problems and where I have complaints about how the government operates things. Okay, off my chest. We'll see. that rant will do no good. So anyway,
but it felt so good.
Well, never mind. It's just, I don't get it.
It makes you furious.
Yeah, it does. If we can stroke a check for $60 billion to send to Ukraine, look, at this point, stroke a check for a couple of billion. Okay. At $35 trillion in debt, it really just doesn't matter anymore. There's just a point it doesn't matter. $1 billion here, $1 billion there. It's a left pocket change. Stroke a check, right? It's not you're going to do any different anywhere else. So anyway. All right, Mike, a few things to talk about this morning. So I was mentioning tomorrow is the big employment report. And right now expectations are for 150,000 jobs is the estimate. Again, it's kind of like the Goldilocks, kind of story, right? Not too hot, not too cold, just, kind of just right. It's not certainly the kind of the booming job growth that we saw last year, but certainly not recessionary at this point. And again, suggests that the economy's doing okay. It's not doing fantastic. Does that, but we just saw the Fed come out and cut rates, 50 basis points, which historically, when they're cutting by 50 basis points, that suggests there's something more at risk in the markets. But at least from the economic front, that doesn't seem to be the case.
No, and you're right. It all comes down to the employment number tomorrow. We've already had JOLTS and we had ADP. JOLTS continues to talk about a market that's just basically, it's like the real estate market. It's not doing anything. There's a lot of job openings, but the number of hires and quits continues to go down, suggesting that everyone loves their jobs, that everything's perfect, that companies are hoarding labor and they don't want to fire people. It's kind of like the housing market where no one is doing anything. No one's buying, no one's selling. The labor market's the same way. ADP was interesting. It came out at plus 143,000 jobs. Like you said, it's fine. It's good. It's a average job growth for a month. But I've been diving into some of the adjustments they made, and for some reason in September, they doubled the seasonal adjustment. So if you don't adjust it, it was down 260,000 jobs. And before you start yelling conspiracy theory, they make massive adjustments to these numbers. I'm looking at them, and like over the summer, they're adjusting the numbers downward by 800,000 a month. So big adjustments, like in this case, 400,000 is not that big of a deal. But when you look so I went back and I compared every September, because really a seasonal adjustment, there's something different going on in each month. So I looked at September's. And what was interesting was that the adjustment for this September was about double the other Septembers. The other Septembers were all pretty much in line, and this one was twice as much. So if you adjust it, you have job growth closer to zero. Not sure what to read into it. Not sure if it matters for the BLS number, but will they make a similar adjustment? If they don't make a similar adjustment, did something happen in the labor force? So, that's all we can do is dig into these numbers and try to get a better sense, not just from the headline numbers, but all these other data sources of what's really going on with the labor market, because the labor market is now pretty much solely driving the Fed. Unless for some reason inflation starts popping up, it's all about the labor market. And if the labor market stays mediocre, the Fed will probably cut slower. If the labor market weakens further, they'll start, probably better chance of 50 basis point cuts. But, I think regarding the Fed at this point, they want to get Fed funds back down closer to the rate of inflation, which is arguably somewhere between 2.5% and 3%.
Yeah, and again, there's other issues that are out there that certainly concern the Fed. I was posted a couple of charts yesterday on Twitter looking at what's happening with overnight repo rates, and we're seeing a very similar spike in those overnight repo rates that we saw back in 2019. And it's interesting because in 2019, the Fed was cutting rates in July, and everybody's like, well, why are you cutting rates, right? It's you were just saying last September that rates weren't anywhere near the neutral rate, and now you're cutting rates. And again, there was everybody kind of this head scratching, and you and I were starting to talk about this rising risk of the repo market. And in September, we really saw kind of a big problem developing in that repo market, and we were writing articles about what that would mean. And that kind of kept developing, and the Fed was cutting rates and trying to offset that risk of that rising repo market. So we do see that issue again with rising rates in the repo market, which may be one of the reasons why the Fed went ahead and cut 50, right out of the gate, even though a lot of the other economic data should have suggested maybe either you don't cut or you just cut 25. But maybe that repo market is something that's also kind of weighing on them. What do you think?
Yeah, I've noticed that as well. You have to be a little careful at quarter ends because funding pressures can increase, but it was creeping up at periods throughout the last month. So let's see if that continues this quarter. And if that's the case, the Fed will probably stop QT. That's probably the first thing they can do to address it. And then, they may get more aggressive with rate cuts.
Well, and I was gonna ask you about QT because I thought that was kind of conspicuously absent in the last kind of Fed meeting, is where they cut rates, but they didn't talk about QT at all.
In the statement, they just said they're going to keep doing what they were doing.
Right. I know, and that's what I'm saying. Is like, they didn't really address it. They just kind of this one little passing byline real quick. In the statement, It's like, oh, QT is going to keep going. But again, I thought we were earlier this year, we had heard conversations and comments from Fed members about potentially reducing the rate of QT, and then that kind of went away. And so then we cut 50 basis points, no real note about potentially reducing the rate of QT at this point. So I think that'll also be interesting if we do start hearing them start to bring back up this idea that maybe they need to start reducing the rate of QT, that maybe there is some more financial stress kind of somewhere, starting to work through the financial system and in the markets.
Yeah, and year end is typically the hardest, the worst point for funding issues. You tend to get more of them. So we may start hearing more about QT coming up. That sets them up to stop doing QT in, say November or December in advance of the year end. But again, that's another thing that the market wasn't paying attention to in 2019. That was telling you there's some real liquidity problems in the market right now. It's just there's a cloud on the horizon. There's not a huge thunderstorm, hurricane coming. But it's just something to watch because we've seen those clouds, gather strength and speed and turn a sunny day into a problem for the Fed. So, and if that happens, we could see more aggressive cuts despite okay labor data, with assuming inflation keeps kind of inching down. And it could surprise a lot of people if the funding pressures continue.
So, and this is going to be one of the kind of the interesting challenges, for the markets. And it was interesting because this morning in particular, I was posting a couple of charts on our Twitter account. And, if you take a look at breadth right now of the markets, we have some of the highest levels of market breadth. In other words, participation in the markets that we've seen. And it was interesting. I had to go back in history and kind of look at, so where did we have previous periods where you had this strong of market breadth? And it's very interesting because, we're talking about an economy that's doing okay. We're talking about a Fed that's cutting rates now. We still have, we just had the yield curves uninvert. And the last time that we had market breadth this strong, where you had similar, and I think I'm going to write an article on this for, maybe next week or something. But the last time you had breadth this strong was in 1999, when you also had the Fed cutting rates and had a yield curve that was uninverting, et cetera. So, it is interesting that, breadth as an example is kind of a blessing and a curse. Breadth means that everything is rising right now. Everybody's doing great. It doesn't matter what you own right now. It's going up in price. And that's what I was saying this morning, earlier, is that if you own something in your portfolio right now that's not working, just sell it, because if it's not working in this market, it's not going to work ever. So this is just kind of where we are at the moment. But Mike, we've got, and just back to the Fed real quick, a lot of this rally, this kind of everything rally we've got going on, is this whole idea of the Fed cutting rates, but also just globally, we've already started to see a lot of other countries cut rates. We're kind of back into that overall easing mode, this rising level of global liquidity, which normally only happens when you have more of an economic issue going on. But again, if you kind of look globally and locally, there's not really, doesn't seem to be, at least on the surface, much risk of that. It's almost, the question is, what do central banks know that we don't know, and what's happening behind the scenes? All right, we'll come back, pick up with Michael Lebowitz. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Medicare open enrollment starts October 15th. If you need Medicare insurance coverage, RIA advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the Insurance tab at realinvestmentadvice.com today. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I grew up in this little bitty town called Lake Jackson. This town was so boring. They named the streets this way, that way, circle way, anyway, and which way.
The Real Investment Show podcast.
There wasn't a lot to do. So on a weekend, everybody would kind of get together and they would drive to Pearland to the flea market. The whole fun of it was trying to negotiate so you could leave with somebody else's piece of crap that nobody wanted. And you say, I got a hell of a deal on this thing. I chewed the guy down to $8 on this rusted wheelbarrow that I bought.
At realinvestmentadvice.com.
So I'm going to go home and spend $30 fixing it up. But hey, I got it. Cheap.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Lebowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, if you're watching our YouTube channel this morning, please give us a like as we beg for you every day. Please click the little thumbs up button. I know it's a big challenge, but just it helps us a lot, and our videos have been getting a little bit more traction thanks to you. We do appreciate it very much. Chat right now is going has gotten off on a tangent about Hurricane Kirk. There is a hurricane in the Atlantic named Kirk. We must pay attention. It is boldly going where every other hurricane has gone before. Where it hits, nobody knows. I mean, there's just somebody needs to just get William Shatner on the news to just announce the trajectory of what's happening with Hurricane Kirk.
Can you imagine Shatner doing a weather forecast?
Oh, this is prime. Somebody needs to do this, or at least a good impersonator needs to do this, and just it would go absolutely viral. Hurricane Kirk. Anyway, that's great. So just for the break, Mike, talking a little bit about market breadth and what's happening. I did mention this morning you were sending out some emails yesterday to the trading team talking about, needing to take some profits in utilities. They're extremely overbought here. Absolutely agree with that. And again, as I was mentioning, you take a look at market breadth. It's actually quite phenomenal just how strong the market breadth has been. And again, I just wrote an article on Tuesday. If you haven't read it yet, it's on the website, realinvestmentadvice.com, talking about the everything market. And again, we kind of went through the charts on Tuesday. But if you missed that, go to the website. It's the second article up. Mike's article is out today. We're going to talk about in a second. But if you take a look at what's going on, everything is going up at the same time. It's Bitcoin, it's gold, it's stocks, it's bonds. It doesn't matter. It's all going up at the same time. And this is just simply a function of so much money chasing so few assets. There was a chart out this morning looking at ETF flows, right? So flows into ETFs. This year has seen the largest flow into global ETFs ever on record. So again, if I'm buying an ETF, then I'm buying all the other assets underneath it. So and again, this is why certain sectors, certain stocks tend to outperform others. And one of the challenges of managing a portfolio is of equity. So if you're, there's two big challenges for investors managing their own portfolio. The first biggest hurdle is psychology, which is all the psychological mistakes we make. We buy high, we sell low, we do loss avoidance, we herd with the markets, etc. So that impairs performance over time. The other, and which was a very interesting chart this morning, is the number of stocks that actually outperform the index. So if you look at your portfolio and your portfolio of equities is underperforming the index, there's a very high probability, about 60%, about 65% probability that you own stocks that are underperforming the index, because out of the S&P 500, only about 30% of the stocks actually outperform the index. So it becomes a very big problem of asset selection if you're trying to manage your own portfolio. So a lot of people have just given up trying to pick stocks and are just buying ETFs now. But that has a dual problem, is that when I put money into an S&P index ETF as an example, great, I want to bench, I just want to get market returns. Okay, that's fine. You'll get average market returns over time. Nothing wrong with that. But when you funnel money into that S&P index, 35 cents of it goes into 10 stocks. The other 65 cents is split up between 490 stocks. And that's why there's such a big bifurcation between the number of stocks that outperform in the index versus those that don't. And when you look at your portfolio of stocks and you go, well, I don't understand why, the market's up 21% this year and I'm only up, 15 or 10 or whatever. It's either A, psychology, right? You were buying high and selling low, or making some other psychological, you didn't have enough money, allocated to equities because you were worried about a bear market, whatever it is, right? The psychological part, or it's asset selection. And Mike, this is one of the big challenges that you and I face, and particularly in this market. We're both fundamental investors. We both want to look at balance sheet ratios and look at price to sales and pegs and all these kind of boring things that are fundamental. But at the end of the day, in this market in particular, it's really been all about momentum. If you want to own stocks that are performing with the market, fundamentals almost take us. Well, they actually have taken a second seat to technicals this year.
Right. And it's for, like you said, it's many sectors. It's not just the Magnificent Seven anymore. Because when the Magnificent Seven was rallying, everything else was kind of just flattish. A lot of things were going down. And as an investor, you could say, okay, I definitely need to own my share of the Magnificent Seven. But those other sectors that were doing nothing are potentially hedges in a way. So when the steam comes out of that Magnificent Seven bubble, those other sectors may be able to carry the weight. So you could kind of, diversify into other sectors as opposed to just reducing exposure if you thought the market was going to go lower. Now it's very healthy that everything is going up together. In our Simplivisor analysis, the relative strength of all the sectors and all the factors versus the S&P 500, they all have scores basically, around zero. Most of them have scores around zero, which is telling us they're all moving in line with the S&P 500. Mm-hmm. So we got really good breadth. Like you were saying, the number of stocks over their certain moving averages, the percentage of the S&P 500 is very high. So breadth is good. But everything is traveling together now. So it's easier to invest in this market, but it's harder to get the diversification benefits of the market while you're invested. So, it's a challenge. This market's always throwing challenges at us. And that's the new one. The one 9 months ago was how much Mag 7 can you buy without owning anything else? Now it's, you can buy anything, and it's kind of easy in that respect, but it's very hard when you think about diversification and what if things don't go according to plan? What if we're not on this Goldilocks track that everyone thinks we're on? Because when everyone thinks you're on a path, it's usually not the right path.
Yeah, and again, this is, the narrative's changed and things happen pretty quickly. And particularly in this market, I was having lunch yesterday with one of our clients, and, we were talking about this, this whole issue of the market, and that, this market is driven so much now by computer programs, algorithms, et cetera, that are making decisions so quickly based on technical changes. A lot of these computer algorithms, and again, like for instance, in Simplivisor, we're creating a whole artificial intelligence-driven program that looks at a whole bunch of signals to generate stock selection based on certain technical parameters. But that's all you have to work with kind of in that environment. And there's the algorithms that run markets. They may have some fundamental bias to them, but they have a lot of technical bias to them. So there's, they're looking at moving averages, they're looking at certain, levels of the market, et cetera. And when those levels are triggered, they're immediately buying or selling very rapidly based on that data. So, this is why the market has become so fast now. When there's a narrative change, as a good example, Mike and I were writing articles earlier this year. Nobody wanted to own utilities and real estate at the beginning of the year. They were dead. The Fed's hiking rates to the moon. Interest rates are going to the moon. They're never coming down again, et cetera, blah, blah, blah. That was the whole story. Nobody wanted to own interest rate sensitive sectors. And so Mike and I were writing articles about, how AI is going to drive demand for energy, and we're going to have to, and utilities should be the beneficiary of that. Well, since that end, and again, we didn't cause the market rally. That was just our thesis. But the market gravitated to that, and all these programs started buying utility stocks as an example. And so we've had this huge move in utility stocks, and a lot of that was based on both the AI story as well as the Fed cutting rates. Lower interest rates are good for interest rate sensitive sectors like utilities, real estate, et cetera. So we've had this huge move in these stocks. But again, this wasn't gradual. It just literally started one day, and as soon as it started, all these algorithms started buying these stocks, right? And you just had this massive move in the markets. Then retail investors go, oh, look what's happening to utilities. So they start buying ETFs, and and it becomes this kind of self-feeding frenzy that drives these asset prices higher. That's the challenge, right? And so by the time you realize that there's a move afoot, it's already had a big move. And the problem is you get trapped into, the buying high syndrome, because you're looking back and going, okay, wow, this is really doing great. And so you start buying in, but you're already kind of towards the end of that move. And this is the challenge that investors face now, Mike.
Right. And, the utilities, for instance, are not a safe sector anymore. The PE for some of these stocks is now back to the upper end of longer term ranges. And those ranges for utilities are pretty consistent. It's not like other sectors. Mm-hmm. So the fundamentals are getting tougher to justify. The rate aspect of the higher dividend stocks should be beneficial. But if it gets too pricey, the benefits may be just, overtaken by market conditions at some point. But, for now, things like anything's a good sector to hang out in. Everything is doing just fine. But you also have to look at these sectors, and you can think utilities are conservative, but they're only conservative when they trade at a valuation that makes them conservative. And they're slipping away from that conservative valuation to something that's not so conservative. So don't assume that a sector is conservative or not conservative, because it changes with the market, with the tone. And that's what we're up against right now.
Exactly. Well, again, if something happens in the market, money's got to go somewhere. And, historically we go, oh, well, go to safe sectors. Money's already went there. So where's that money going to go to next? All right. A crystal ball. Is it enough? The importance of context. We'll talk about Mike's latest article and come back from the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Medicare open enrollment starts October 15th. If you need Medicare insurance coverage, RIA advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the Insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show this morning. Be sure and like the channel. We certainly appreciate it as always. Yes, I'm going to keep annoying you until you do it. And if you don't click the like button, it's that little thumbs up button right below the video, right? Just click that. If you don't do it, I'm going to do more Kirk impersonations. So Brent just said, please no. So Mike, you wrote an article yesterday on the website called "The Crystal Ball Isn't Enough." Let's talk about it.
So a few days ago, about a week ago, someone on Twitter who follows me closely, and she seems particularly interested in when I talk about bonds, wrote something like in disbelief. Can you believe bond yields have risen for 5 or 6 straight days, even though the Fed cut rates by 50? Have you ever seen anything like it? That was the gist of the message. Mm-hmm. And it got me thinking about that. How would I address that? How could I address it in an article, not just a little comment on Twitter? Then our colleague Richard sent us the Crystal Ball Challenge. And this was a pretty cool challenge where it gave you the headlines for 20 newspapers over the last, I think it was 15 years, 20 years?
Yeah.
And it said, okay, here's a headline. And you can use leverage in both stocks and bonds. How much would you invest, and is it long or short? And for each headline, you could do nothing, or you could go long stocks, you could go short bonds, short stocks, long bonds, and also size the bet based on the amount of leverage that you used. And some of the headlines were, you think you have an idea of what happens in the next 72 hours, like Fed cuts rates. Others were very hard to distinguish. So they gave this challenge to 118 students that were trained in finance, and they basically got about 50% of the trades right, and they lost money. They gave it to some professionals, like they gave it to 5 seasoned professionals who only got about 60, I think it was 63% right, but they sized their bets much better. So the ones they were confident on, they bet more. The ones they didn't really know how it would affect the market, they didn't bet, or they bet less. So, that kind of got me to this. It's all about context. So even if the Fed met on September 18th, on September 16th, if you said the Fed's going to cut 50, what's the market going to do? And it's easy to say, oh, the bond market's going to rally. The Fed cut 50. But that there's no context to that. We don't, without appreciating that the market for bonds was very overbought, that's a tough statement to make. And I'm going to quote, I'm actually going to put on my glasses here. That's how official I'm going to get. So Lance, dorky here. Lance, 2 days before the Fed meeting, in our daily commentary, we write a technical section, and Lance wrote this one. And he said, as shown, Treasury bonds, as represented by TLT, are quite deviated from the 50-day moving average and overbought on multiple levels. He then goes on to say, with the Fed meeting this week, the current setup suggests that even if the Fed cuts rates as expected, this could be a buy the rumor, sell the news setup for bonds. Still bullish on bonds, and he notes that in the article, but bonds were just very overdone. Mm-hmm. And that's the context. So, you can go in the article, you could take the challenge, and you could see what context headlines get you. It gets you nowhere. Headlines, having ESP, having a crystal ball is nice only if you have the context. And that context can be technicals, it can be sentiment, it can be the political situation, geopolitical. There's a lot of context to markets, and that's why we focus on technicals so much, because it provides us context for what's going on. Even if we think the economy is going into a recession in the next 3 months, that inflation is going to drop like a rock, that this port strike is going to just continue for 3 months, that context helps us better appreciate how we should be playing, how we should be investing in that. Because the obvious answer, you should be long, you should be short, you should be buying stocks, you should be buying bonds, buying utilities, or buying tech, may not be the right answer. So the crystal ball on its own is nice to have, and it may be a lot of fun, but without context, it can be almost meaningless.
Well, and again, that we see this, it's a very interesting challenge. I took it, you took it, and it's interesting because you do look at this and you're like, I'm absolutely sure that this headline is going to mean this, and it doesn't work out that way. But but this is the challenge that we have over time across markets, and again, always kind of pick on the SPIVA, which is the S&P report that puts out every year about performance of managers and how they did relative to their benchmark. And every year they say, well, this past year, 85% of managers underperformed their benchmark. And it's true, right? That's a true statement. Markets are going up very strongly, whatever, so they don't have enough allocation, so they underperformed the benchmark. Or if the market's going down, they went down more than the market. But what it doesn't tell you is that it's measuring this across all managers, large cap, mid cap, small cap. So it's looking at this across every manager, but it doesn't say that this manager has been underperforming his benchmark, every single year for the past 10 years. It's just a kind of a broad analysis. So you may have one manager this year that underperformed, but the manager that underperformed last year killed it this year. And so to your point, context is very important when you're looking at these data points like this, because again, there's managers that have certainly underperformed over time, from one year to the next. Take a look at Fidelity Magellan Fund, Peter Lynch. Take a look at Fidelity Contra Fund, or Berkshire Hathaway has certainly Warren Buffett certainly underperformed markets at times from one year to the next. Look at their long-term performance; they've killed the markets, right? They have massively outperformed markets over 20 and 30-year periods. But this is the problem with looking at these types of reports, looking at this this kind of analysis, jumping from one portfolio to the next. That my portfolio underperformed last year, so I'm going to go buy this year. Great example right now. This year, gold is really outperforming, and there is a company called Callan that produces this periodic table of returns for every year. And it shows you what was the best performing sector all the way down to the worst performing sector, every year. And what you'll notice is when gold has been the top performing sector in a given year, it was not the top performing sector for the next 5 years or next 10 years sometimes. And that's just simply because of rotations and crowding and all these other things. So it's important to understand context, as Mike is talking about. It's easy to think that what performed last year is going to perform next year, but historically that's not the case because things change and markets change on a regular basis. So you have to be able to adapt and adjust your portfolio to adjust to the narrative. Particularly, as I said earlier, in this market, everything moves so fast because of computers. These narratives are changing very rapidly versus the way they used to back in the in the 80s, Mike, when in 90s it took months for a narrative to get to the markets. Now it happens in minutes.
Right. Everything is sped up on steroids, and it makes it just quicker. But going back, if I would have said starting in June, who would do better, Nvidia or utility stocks? The obvious answer from everyone would have been Nvidia, right? It was just flying all year. Well, Nvidia is down a little bit since June, and utilities have done nothing but gone up. So, what changed? Not much, except the sentiment of the market that Nvidia was just overbought, utilities were oversold, and these markets rotate. Markets can't stay overbought or oversold, and they're always going to rotate. It's just trying to figure out when that level of overboughtness is too much or that level of oversoldness is too much, and you're going to get some kind of headline or some sort of event that changes the market's sentiment. And that's what we have to pay attention to. That's what matters in these markets. And like you said, with the internet and everything else, that change of sentiment happens much quicker than it used to. So you have to get onto these cycles quicker than in the past. You don't have as much time to wait for more technical affirmation. So that's the world we live in, and that's what we have to do here.
Yeah, exactly. So next Fed meeting is in November. It'll be after the election, of course. And so again, I think right now I haven't checked the odds here over the last few days. There was still a decent bet being placed on another 50 basis point rate cut, and we'll see what happens after the employment report tomorrow, whether or not that potential bet goes, increases or not. But you just, into the end of the year, do you think the Fed gets more aggressive, or you think they just kind of keep their path, and do they start to talk about QT and reversing that some more?
I think it's all about labor. If the labor markets are okay, if we print 150-ish thousand jobs, I think they just go 25, like they told us. They put out their economic projections, and they told us they were going to go basically 50 more. So we should expect 25 and 25 unless something falls apart.
There you go.
Unless there are funding issues.
Yeah, there you go. Thanks, Mike. Appreciate it very much. All right, wraps up the show for the day. Get by the website. Get Mike's latest article. It's on the website now, realinvestmentadvice.com. Also, check out SimpleVisor for all of our trading information, as well as all of our market analysis, tools, etc. If you're managing your own portfolio, it's a great tool for you to use to help you manage your own money. SimpleVisor.com. You'll actually see our portfolios there as well, so you can track along those yourself if you're managing your own money. SimpleVisor.com. First 30 days are free. Get by the website. If you have any questions, send us your comments. We'll be happy to help you out. Have a great day, and we'll see you back here tomorrow for Financial Fitness Friday.
Hey, Brent, do you want me to return these cameras and get